In this video, we're going to talk about the massive surge in IPOs that is happening over the past couple years, and two IPOs that have a massive upside that you may not have even heard of. So stick around. Hey guys, welcome back to the channel. My name is Richard Allan. Thank you so much for joining me for another video. It's Friday, so I hope you guys are prepared for the weekend. It's going to be a great weekend here in Minnesota. Beautiful, beautiful weekend, and I'm excited to spend some time with the family. So we're going to jump over to this article on tipranks.com. It's JP Morgan pulls the trigger on these two stocks. Now, there has been a crazy flurry of activity in the IPO realm, and some investors and analysts think that's a good thing because there are less companies now than there were, say, 20 years ago during the dot-com bubble, but we all know how that turned out. And some people think it's not such a good thing that we are nearing a time where there is another bubble that's about to pop. So we're going to talk about two companies that you may not have even heard of. But first, we're going to talk about a little bit of what's going on in the IPO realm. So let's jump over to tipranks.com. Check this out right here. It says, before the COVID crisis derailed the economy, markets were on a tear. And one facet of that was a surge in IPOs. That surge year has seen over 200 companies go public, a 200% jump from the first year of 2020, the first half of 2020 rather. Before assuming that the magnitude of the surge is an artifact of the corona shutdowns, note that in the first half of 2019, pre-corona, there were only 80 IPOs. It's not just the number of IPOs that has market watchers taking notice. The sums raised are also considerable. Even during the pandemic year, IPOs raised over $78 billion. This year, the newly public companies have already beaten that mark, bringing in over $80 billion in new capital. And that number does not include the increasingly popular alternative modes of going public through direct listing SPAC mergers. The solid momentum in IPO activity is attracting attention from Wall Street stock pros who are looking under the hoods of newly public companies to find the ones that truly deserve investors' money. Using the TipRanks database, we've looked up two stocks that have recently held their IPO and have 5-star rated analysts from JP Morgan predicting over 25% upside for the coming year. Let's take a closer look. The first company we're going to profile is a Lifestance Health Group, or ticker symbol LFST. Mental health is a segment of the healthcare industry that is steadily gaining a higher profile. It's not that severe mental illness is growing more prevalent, rather the field is slowly shedding the stigma that has long surrounded mental health issues, and people are more likely to seek and receive treatment. Lifestance, founded in 2017, has quickly grown to become one of the nation's largest providers in the field, offering a combination of in-person and telehealth options for patients of all ages. The company boasts a network of 370 clinics with more than 3,300 clinicians, including psychiatrists, psychologists, clinical counselors, and social workers, and also nurse practitioners located across 27 states. Lifestance provides services ranging from adult psychiatry and individual therapy to couples therapy and child and/or adolescent treatment. Treatment plans are designed around each patient's needs, and the company has payment agreement with most insurance plans. Lifestance opened its IPO on June 10th of this year and closed the sale on June 14th. The initial offering saw 40 million shares go on the market, of which 32.8 million were sold by the company and 7.8 million by existing shareholders. The shares were priced at $18 each, and the underwriters have an option to an additional 6 million shares. The IPO brought in over $720 million in gross proceeds before deducting expenses. JP Morgan analyst Lisa Gill, who is rated in the top 10% of Wall Street stock pros, notes the company's potential to shake up mental health field. Here's what Lisa has to say. The largest outpatient behavioral health platform in the U.S., Lifestance, aims to disrupt the traditional model, which suffers from 1, low reimbursement rates for clinicians, 2, accessibility and affordability challenges for patients, and 3, lacks connectivity for the integrated care model. The company's unique model is supported by their technology-enabled infrastructure, virtual care capabilities, and expanding national payer relationships, which enables a national base of qualified in-network clinicians to provide care at a lower cost than traditional models. The bottom line, Gil is bullish here, saying, going forward, we believe that the continued market share expansion will benefit the company as their network payers, referral sources, and clinicians count increase. Let's jump over to the analyst page here on LFST or Lifestance Health Group. This stock is up 0.19% today, but this comes in with a strong buy based on 6 analyst ratings with an average upside of 28.31% for Lifestance Health Group, ticker symbol LFST. All right, let's jump over to the second company that's going to be profiled today. It is Marqeta, ticker symbol MQ. Marqeta got started in the payment processing world back in 2009 and has since become a major online card issuer and payment processor, using its open API card issuing platform to make waves in the online payment niche. The company aims to make virtual and tokenized cards along with their physical analogs customizable, and by linking them to a single primary account to streamline the digital payment process. The company's business clients include names like Square and DoorDash. To date, Marqeta has issued over 320 million cards through its platform worldwide. In mid-June, Marqeta held its IPO. The company put around 45.45 million shares of common stock on the market, initially priced at $27 per share. The initial offering saw the company raise more than $1.41 billion in gross capital. The company reported Q1 results prior to its IPO, showing gains from the year before. At the top line, revenue came in at $107.9 million, more than double the first quarter 2020 figure. While Marqeta typically runs at a net loss, the loss narrowed year over year in the first quarter of 2021 from $14.5 million to $12.8 million. Tien-Tsin Huang, another of JP Morgan's 5-star analyst, sees Marqeta's modern tech platform as a key to the company's ongoing success. We forecast a 35% revenue CAGR, or compounded annual growth rate, midterm, making it a bona fide fintech growth stock with a premium valuation that is rich but substantial on our sector thesis that 1, modern platforms are share gainers versus legacy, as 2, software and payment convergence accelerates, and with software tech firms well positioned to bank their users, Huang wrote. Huang goes on to outline his view of the company's potential. Marqeta's modern tools and infrastructure featuring open, configurable APIs represent gravity for developers at high-growth firms to seek out Marqeta to create customized payment card programs for users. With software and payments converging, MQ is very well positioned to be in the flow of new work, especially relative to legacy processors. Let's jump over to the analyst page here for Marqeta, ticker symbol MQ, up 2.24% today, coming in with a moderate buy based on 9 ratings with an average upside of just over 20%. Guys, thank you so much for joining me for this video. Let me know if you have a favorite stock on this list, and let me know if any of you are invested in either of these companies. I hadn't heard of either of these companies, and it's cool to see that Marqeta are working with some big names like Square. So guys, thank you so much for joining me. Have a fantastic weekend. Remember, I do your Power Hour update at 3 p.m. Eastern Standard Time on the Tip Ranks YouTube channel. So if you haven't subscribed over there already, please go ahead and do that, because you can see me on Monday. I'll see you next week. Thanks.